This is the morning brief from the Economic Times.
Investors in the Paytm IPO are not a happy bunch.
The moment I saw Paytm has got listed at a discount, I mean, it was a shock to me. Paytm, I was assuming a lot of good investors had come at Paytm, so I was not expecting Paytm to go on such a nosedive listing kind of a thing.
I was in for the listing gain, and it had become a listing loss. So then I waited. I thought that it would rise up or something. I'd get out unscathed, like no profit, no loss or something. But no,
I'm in this for the long term, and I've read the Macquarie reports and a bunch of other analysts. Extremely valid points, but internet businesses do take time to mature. There's a lot of white space available in the domain, and to be honest, I didn't panic because I knew I was in it for the long haul. I would definitely love to buy more, and I'm planning to buy more.
You just heard from Rajesh, Lakshay, and Gurudat, three of the thousands of people who invested in the Paytm IPO. The value of their investments fell by almost a third as India's largest IPO made a flop debut on the stock exchanges. Paytm shares declined for 2 straight days on the stock exchanges, falling to as low as 1,271 rupees before recovering in the next 3 sessions. However, share prices are far below the issue price of 2,150 rupees. Many investors who were looking to make a quick buck in the listing were in for a rude shock. What led to such a disastrous public market debut for the Vijay Shekhar Sharma led company? And more importantly, what's in store for the IPOs that will be following Paytm? Does the gloom pass on to them? How should retail investors play the IPO game and choose which stocks to put their money in? We'll find answers to that and more in today's episode. It's Friday, November 26th. From the Economic Times, I am Nehal Chaliawala, and you are listening to Paytm's Aftershocks on the Morning Brief. Payments and digital wallet company Paytm last week made what was India's largest IPO. The company raised 18,300 crore rupees from investors. It's one of the many new age companies to come to public markets this year. Companies which make little to no profits but have a unique business model and promise huge dividends in the future. Think Zomato, Policy Bazaar, and Nykaa. While the first 3 IPOs sailed through and gave bumper listing gains to investors, we just heard what happened to Paytm. It has also cast a doubt on the success of the future IPOs. According to a report from Business Standard, shares of unlisted companies on the grey market have fallen as much as 40% this week alone. Grey market is an unregulated parallel market. Here, shares of unlisted companies are traded.
It could impact the valuations of some of the fintech companies that are possibly looking to come into the market. Um, the question that now fund managers or any investor would ask is that, why should we kind of pay the premium valuations that, you are asking?
That is Nishanth Vasudevan, ET's markets editor.
Now, after Paytm, what is going to happen is that fund managers and other investors, they will probably be able to push back these startups on valuations. So far, these startup companies were dictating terms with investors and they were arm twisting them into accepting just about any valuations. Now, investors could have an upper hand. They could say that we don't want to give you just any valuation that you are asking. And that is what happened in the case of MobiKwik. They were not able to kind of garner the kind of support that the previous IPOs had garnered regarding valuations. And so either they will have to cut their valuation expectations, or else they'll have to defer their IPOs till the time there is that frenzy once again about these startup IPOs or fintech IPOs.
And what about IPOs of conventional companies, profit making companies like LIC? Will they be impacted too?
I don't think they will be impacted by the Paytm listing as such. Again, it depends on the secondary market and the listing gains that have happened till then. So till the time the secondary market is robust, mid and small cap shares are giving good returns. Most IPOs are also likely to give good money. Now, in the case of let's say LIC, it is going to be the biggest IPO. The sense that we are getting from bankers is that they are planning to split the IPO so that it does not suck out all the liquidity from the market. So it all depends on uh, how the sentiment is at that particular point, and also how the government decides to price the LIC IPO at that juncture.
Secondary market means the stock exchanges. The primary market is where the company issues new shares to investors. In the secondary market, investors trade these shares with each other. While the Paytm saga may have spoiled the party for future IPOs in India, a more fundamental question is, what about the retail investors? In IPOs, the company that wants to raise money gets its money. And if the stock prices tumble, larger institutional investors can afford to wait and let their investments recover. But it is the retail investors who are in for a listing day gain and make a quick buck who are forced to book losses. Like Lakshya.
When I applied for Paytm, I actually had some hope that I'd get some listing gains on this share because from my past experience, Zomato was a similar performing company to Paytm, right? The amount of profit it was making, I mean, loss it was making, and the turnover and all, the past record, it was more or less the same. And investors had a good gain on that share. So I was hoping that I'd make the same amount of gain as well on Paytm. So I went ahead with it.
Lakshay sold his Paytm shares at a price of 1,740 rupees, taking a loss of 19%. All this makes one question if IPOs are nothing but a game of chance, or is there a method to the madness?
I have always maintained that IPO investing is almost similar to gambling. Let's say if there are 10 issues, you would make money in 8. That will probably cover up for the losses that you probably make in 2 out of the 10 issues. If you're a long term investor, if your horizon is long term in the markets, then IPOs are a strict no. So while it is important to book profits on listing, the Paytm listing shows that it is also important to cut losses if there are any.
And how do investors make a good bet? I mean, what do they look at while choosing to apply for an IPO?
See, the fact is that, one thing that most investors, they most, at least I can tell you from a retail and HNI point of view, that they really do not study an IPO. But that said, if somebody wants to really study an IPO, what he should be doing is compare the valuations of the IPO, the price at which the shares are being offered. You compare the valuations of the stock to a listed entity, if there are any. Similarly, you should also look at the profit record, the revenue, how much these companies have been making in the past, let's say 5 years.
When you mention that you can look at the fundamentals of the business, their revenues, their profits, there aren't many when it comes to new age companies like Paytm or Zomato. There aren't any profits, right? So, do we need a new set of metrics to gauge these new age companies?
See, you are right. Traditional valuation parameters don't essentially work for these new age businesses. You have your typical ratios like the most commonly used price to earnings ratio, which essentially doesn't matter over here, because the thing is that many of them are loss making companies. So that is also one of the reasons why many of the fund managers or many seasoned investors do not participate in these IPOs. First of all, it requires a different mindset, and also there are the parameters that are used by private market investors like venture capital funds. Those are a little different, and those are not essentially understood by public market investors like like a mutual fund manager or an insurance fund manager or even a foreign hedge fund. So many of these public market investors are yet to come to terms with these IPOs and the different kind of parameters that these private market investors are deploying to value these companies.
Understood. For the retail investors, do gray market premium and say the number of times an IPO has been subscribed? Do these parameters make good indicators?
So, in the case of shares, the activity in this gray market usually picks up before an IPO. For an investor who invests regularly in IPOs, the gray market prices are an indicator of the demand for a particular stock before listing. But it also needs to be understood that the gray market can be easily be rigged. So one needs to be careful about how you read gray market prices. It should also be read along with the sentiment, the broader sentiment in the secondary market.
So, as the Paytm episode shows, investing in IPOs is risky. But that was the case even for the IPOs of Zomato, Nykaa, and Policy Bazaar, right? Then why did Paytm stock tank when others were a success? To understand that, I had a chat with my morning brief co host and ET senior colleague Arijit Barman. Hey Arijit, remember we had a bet when Zomato was about to list? I told you that it will tank on the listing day, and you said if it does, you will come down to Surat to meet me.
Yeah, I won.
Of course. For Paytm, I think I had a similar hunch, although we didn't have a bet. So, were you surprised to see Paytm tank so much on its listing day?
Not really. I have always maintained that there is more hype around Paytm than the real meat. So I wasn't surprised. I wasn't surprised at all. The signs were ominous. One is if someone studies which are the institutions who are coming in as part of the anchor book allocation, um, that's a clear indication. And when hedge funds like Marshall Wallace were part of the anchor book, you realize that there was an inherent problem. Yes, on one hand, you had the most pedigreed investors, CPPIB, that's a Canadian pension fund, ADIA, which is Abu Dhabi's sovereign wealth fund, BlackRock, the world's largest asset manager or mutual fund, putting in money. In fact, CPPIB doubled down and in many ways perhaps saved the IPO later. But the moment you have hedgies in your anchor book, there is a spot of trouble.
Understood. So, why did Paytm stock decline so sharply on the listing day? Was the stock overpriced? Because it goes on the same line as Zomato, Nykaa, and Policy Bazaar, right? But the other flew through, but Paytm stumbled.
Well, for one, Zomato, Nykaa are both market leaders in their own space. Nykaa is also profitable. And so that's one, that Paytm is not profitable. Add to that a layer of regulatory risks and uncertainty, and you realize that Paytm, despite having the early mover advantage, has lost most of its moat. If one reads the DRHP, I mean, I just read out a para and you will know what I'm trying to say. I quote, "We expect to continue to incur losses for the foreseeable future, and we may not achieve or maintain profitability in the future." So it's admitting that it's going to be loss making for a long time. Then it goes on to say, "We cannot assure you that we will ever achieve or sustain profitability and may continue to incur significant losses going forward." Well, these are the management's own admission. Now, so you can understand what is the issue? That it's admitting that we will never perhaps make money. Would you back such a company? I wouldn't. Many people did.
As bad as that may sound, no visibility of profits isn't the only thing that Paytm has going against it. As per a Macquarie research report, which was released just on the day Paytm shares listed, Paytm has, and I quote, too many fingers and too many pies. End quote. The company started life as a payments company. That's in its name, right? Pay through mobile or Paytm. But it soon diversified into a number of businesses: e commerce, ticketing, stockbroking and mutual funds, gaming, consumer lending, and many more. Being in so many businesses prevents it from being a leader in any of these except payment wallets. Paytm declined to comment for this podcast. But here's what Vijay Shekhar Sharma said in an interview to CNBC TV18 about Paytm's business model.
The core revenue model of ours is bring customers for payments, charge the high-end customers, the shopkeepers, the merchants, bring 0% MDR so that you are able to bring the inclusion, and the large merchants, large businesses that need sophisticated payment systems and services, they pay us money. So payment has its own revenue line item, which gets double down on a next level of line items, which are higher contribution margin, which are in financial services, credit, insurance, wealth, commerce, ticketing, digital goods. I'm surprised when the business model moat is understood, it is payments, and the revenue model is financial services and commerce. And I believe that if you were to say the single engine, I think that's where the problem is, that there are two ways to look at companies. One is called point companies. For example, like if you look at Amazon as a retailer, that they stock their warehouses with some item and then they sell those items, you're missing the story of Amazon. And not to say that that is not their business model, but that's the beginning of a platform build-up. And then there are platforms which includes AWS, content, and every other line item. So that's exactly what for the Paytm is. Paytm is a platform business where the customers come for one service and then have other services, and every one of them earns revenue.
The Macquarie report also said that another reason to worry for Paytm is competition. In almost all the businesses that the company is, it competes against the likes of Google, Amazon, Walmart owned Flipkart, Facebook owned WhatsApp, and Reliance. These are deep pocket companies who can fund losses for a long, long time. That doesn't sound good, does it?
Add to that, I wanted to tell you that until and unless Paytm does a Bharat Pay and gets access to lending or has a shadow bank in its fold, if you remember, Bharat Pay and Centrum teamed up and took over a troubled cooperative bank, the PMC Bank, right? Only then can you get access to people's deposits as a lender, as a bank. And in this business, if you want to be a successful shadow bank, the raw material is money. In the business of money, the raw material is money, right? And how cheaply can you access that money to lend it to somebody else, right? And that's the arbitrage that people play on. But the problem is the banking regulator, which is RBI, has been sitting on Paytm's NBFC application for the last 2.5 years. Even its request to become a small finance bank from the current payments bank setup that it has is being held up after the RBI came down heavily on the company in 2019 for audit lapses.
Investors have been willing to pay ridiculous premiums for quite some time as markets are flush with liquidity. There's money everywhere. If one were to look at the stock markets and the economy, they seemingly exist in two different realities. The economy is still recovering from the pandemic. The central bank is worried about inflation and economic stagnation at the same time. But the markets? Well, the Nifty 50 index has given 35% returns in just the last 1 year. It's crazy. The Paytm debacle, however, makes me wonder, is it the beginning of the end? Is the market euphoria finally over?
No, not at all. Paytm, it looks like it was a very Paytm specific issue as such. I don't think this is going to impact the sentiment as such. There are far bigger issues that could impact sentiment. Of course, one is valuations as such. The second is the monetary policy tightening that will possibly start by the end of this year in the US and possibly in India also. So let's say that interest rates firm up. That is a question when a lot of investors would start questioning the risk reward ratio in equities. They might possibly think that, okay, fine, I've made some money in equities. Is it time for me to kind of book profits and move a bit of my money to safer asset classes? So it all depends on how long this liquidity cycle continues.
So it may not be end of the euphoria for the entire market, but for some Paytm investors, this was a wake-up call. When asked if they will be investing in IPOs again, here's what Rajesh, Lakshay and Gurudat had to say.
I would be cautious on investing in such kind of IPOs. I mean, if the same share is available at a discount from the secondary market, why should I invest in an IPO kind of a thing? Definitely, this is a learning experience for us also.
I'd wait for a bit to start investing again because I need to recover from the loss which I made. It was not too much, but yeah, it is enough to hurt you. Like, I just need to think straight now, be a bit more logical about it.
I would definitely go for IPOs that are in the local parlance or are everyday use cases, right? So I'm extremely bullish on these companies, especially that have whether consumer is actually using the app or the platform multiple times in a day or multiple times in their lifetime. There's a lot of euphoria, especially after Zomato debuted on the public markets. So there are a lot of retail investors that are coming into the space hoping to make a quick buck. I would say don't get into that trap. Invest if you really believe in the brand and the business and not because you want to make a quick money.
Paytm's performance on the stock markets just shows how IPOs are very similar to gambling. One can make a quick profit, but there will be losses too. If you have a long-term view on your investments, best avoid IPOs. The losses incurred in the Paytm IPO will leave a bitter aftertaste for many investors. It could impact upcoming IPOs as well, especially in the fintech space. Investors will push for more modest valuations. But in the long term, the primary stock market will depend a lot more on the sentiment in the secondary market and the liquidity in the system. That's all from us today. You were listening to Paytm's Aftershocks on the Morning Brief with me, your host Nehal Chaliawala. Producers, Diya Rekhi from The Economic Times and Soundarya Jayachandran from Awaaz. Sound editor, Varun Kapahi from Awaaz. Executive producer, Arijit Barman. If you enjoyed listening to this episode, please consider sharing it on your social media handles. Send us your feedback to themorningbrief@timesgroup.com. The Morning Brief airs every Tuesday, Thursday, and Friday. Thank you for listening and have a nice day ahead. Credits for all external clips used in this episode have been mentioned in the description.